Today we are going to look at 3 very interesting magic formula stocks. Now, if you don't know what is the magic formula, don't get scared. It is not a get-rich-quick scam, even though the name is really bad. The magic formula is an investing strategy created by Joel Greenblatt, a great investor and a professor at Columbia Business School. And this formula looks for companies that are both good quality, companies that earn high return on their capital, meaning they are very efficient at using their money to make more money, and that are also cheap, companies whose stocks are available at bargain prices relative to their earnings. The formula works like this. First, it ranks all the companies above a certain size based on their return on capital, how efficiently they use money. Then it ranks them based on their price to earnings ratio, basically how cheap they are compared to their profits. And finally, it combines these rankings to create a final list of stocks. And the beauty of this approach is its simplicity. However, like any investment strategy, it's not guaranteed to work all the time, and investors should understand the risks before using it. If you want to learn more, I really encourage you to read Joel Greenblatt's The Little Book That Beats the Market, or at least watch my video about this book and the formula. Okay, so let's start our rapid-fire analysis. And first, let's take a look at Crocs, ticker symbol CROX. So it has a price-to-earnings ratio of 7.3. That is very low. And when we look at the financial health, we see that return on invested capital is 19.6%, so that is really nice. We like to see it over 10%, so that's great. Margin 19.8%, also great. And years to pay debt, 1.5 years, so that is good. We are looking for this number to be under 2 years, so that is really nice. And when we look at the growth, revenue growth, 12.8%, so that's good. But when we look at free cash flow growth, it is 34.1%, and earnings per share, 59.5%. So that is a very nice growth. And Crocs doesn't pay any dividends at the moment. So at the first glance, I have to say I like it a lot. We only have to pay $7 for every dollar this company earns. Financial health looks great, and also the growth looks really nice. So I would definitely spend some more time analyzing this company. Next up, we have Abercrombie and Fitch, ticker symbol ANF. So it has a price to earnings ratio of 12.3, and the S&P 500 average is around 27.3. So even this 12.3 price to earnings ratio is actually quite low compared to the current market. Return on invested capital, that is only 2% in the last 10 years. So that doesn't seem right for the magic formula stock, because it should have a really nice return on invested capital. But if we look at 2024, we see that then it had a return on invested capital of 17.9%. So basically, it has a really nice return at the moment, but in the long term, when we look at 10 years, it is not so good. So this company is definitely going through some big changes. Net profit margin 2.5%, so nothing special, and years to pay debt 0. So they have no debt. That is really good, because as we know, it is very hard to go bankrupt without any debt, and That is what we like to see. Growth. So revenue growth is only 0.4%, but when we look at free cash flow, it is 45.6%, and earnings per share 24.6%. So again, it all seems that there is a bit of cyclicality here, and that this company is going through some restructuring, and it is getting more and more efficient because the revenue is growing very slowly, but free cash flow and earnings per share are going up very, very fast. And Abercrombie and Fitch doesn't pay any dividends at the moment, which is probably wise considering how fast they're trying to grow and rebuild the company, because we see a bit of cyclicality, and it is a company that seems to be getting out of some serious trouble. And well, the growth is really impressive, so it may be worth a closer look. And finally, we have HP Incorporated, ticker symbol HPQ. So it has a price to earnings ratio of 11, so that is nice. Financial health, return on invested capital, 51.9%. That is really, really impressive. Margins, 6.3%. That's fine. And years to pay debt, 2.6. So it would take them over 2.5 years to pay the long-term debt with a current free cash flow. We like to see it below 2 years, so that's a bit high, but nothing really bad. And then the growth. Well, revenue minus 0.6%, free cash flow growth minus 10.3%, and earnings per share 0.7%. So that is really, really bad. This company is basically shrinking, or when we take into consideration the share buybacks, then it is growing, but like barely. But this company pays dividends. It has a dividend yield of 3.4% and a payout ratio of 39.2%. So that is a very nice dividend. And it is a bit of a different story. The price seems interesting. Financial health looks very nice. Well, maybe except the debt. It is not huge, but we like to see it below 2 years. But unfortunately, the company is not growing, and that is a very big red flag. On the other hand, we are getting some nice and secure dividends, so it is just a bit of a different play. And if you would like to learn more about any of the companies we just talked about, then check out my videos in which I analyze them. Thank you so much for watching, and see you in the next one.